We start today's market talk. Since we are meeting for the first time this year, may your investments be boring and your returns be adequate. The coming months will bring surprises, some pleasant, some not. Markets will move in ways that look obvious in hindsight and are impossible to forecast in advance. So build a portfolio robust enough to handle whatever arrives. Market construct. A US attack on Venezuela was the opening salvo of the stark new global strategy that treats alliances as transactions and sovereignty as conditional. Trump has been making belligerent statements on Cuba, Colombia, Mexico, and bullying Greenland. There is a consistent demand to align their security, infrastructure, and economic choices with the US preferences. This is not about military bases, it is about supply chains, investment flows, and market access. The ultimate vision is a fortified US centric ecosystem of alliances and economic relationships that sustains American primacy in the 21st century not through benign hegemony but through enforced discipline, wielded via economic leverage and hard power and the deliberate exclusion of strategic rivals. Now, what happens here is that India stands out as an example. US aims to deepen commercial ties with India, to encourage India to contribute to India-Pacific security by spending on defense, invest in capabilities that align with US objectives and provide access to ports and facilities. The threat China poses is that its state-led development model demonstrates that large-scale industrialization and technological upgrading can occur outside Western financial and institutional discipline. So objective is to prevent competitors from consolidating alternative circuits of trade, finance, and development, create exclusive spheres of influence like Latin America as a backyard and Arctic as a resource frontier. So what is happening now is that defense spending, border security infrastructure, surveillance technologies, and private military contractors are the new center of accumulation, reflected in Trump's proposal for 1.5 trillion US defense budget and the rise of defense stocks. Sudden sanctions, trade ruptures, and regime change operations will make long-term investment planning very difficult, elevating risk premiums. So old order of all, with all its deficiencies, at least provided predictability. The new ones have no rules, hence the uncertainty. Now, fresh US tariff threats unnerved Indian equities this week, and we have seen how the markets corrected big time. Now, coming to FIDI data. So, this week, both FIs, pros, and clients have taken extreme positions. FIs are short on index futures, sold calls, bought puts in index options, and are strongly bearish. Pros, they are long on index futures but have sold calls and bought puts in index options. They are also strongly bearish, while clients, they are long on index futures, bought calls and sold puts in index options and strong put writing. They have done. They have sold around 5.07 lakh index puts. So they are also strongly bullish. Now, if you see the monthly FIDI data, the FI short positions in index futures reduced to 1.44 lakh on 30th December. That was the day of expiry, and then it has gradually increased, and now it is at 1.86 lakh. They have been on the days they have been selling index futures and shorting index options or buying puts. The Nifty has also corrected. So on 8th and 9th Jan, the Nifty corrected substantially because of mostly the FI action. Now coming to US, so if you see US stock indices climbed to new highs last week, while energy and precious metals saw significant volatility due to unrest in Iran, leadership transition in Venezuela, etc. Now, this week the non-farm payroll data is a mixed kind of data. So There is a probability of a Fed rate cut in first quarter, but may not be in January. So bond yields are also didn't move too much. Uh, Declined a bit as investors digested the jobs data, but it is at still at around 4.169. So normal. The dollar index climbed up, closed above 99 mark. Dollar benefited from its role as a liquidity refuge due to global instability. Gold climbed up 4%, safe haven demand and Iran unrest. Silver volatile moved around 10% after 10% move last week. High volatility hit by index rebalancing. Copper hit $6 and then pulled back. So let's see what happens from here. Bitcoin was stable, nothing much happened. Brent crude climbed up uh, around 3.48%. Fears of supply disruption from Iran led to this. S&P 500 made a fresh high, touched 7,000. Uh, Nasdaq 100 is again was positive, 2.22%. And Dow Jones is heading to 50,000 now, so went above 49,000 levels and was up 2.32% above the all-time highs. Now coming to India, India VIX has risen as the volatility has gone up. It was on Friday only India VIX was up 3%, but if you see there is a from 9 odd level it has moved to around 11. So there is a big move which around 20-25% move which has taken place in India VIX. Nifty, if you see here, uh, that it dropped around 2.45% and is now on 20 EMA on the weekly chart. So this should be first level of support. And if this breaks, then you see here it has broken through the 20, 50 and taking support at 100 EMA. So if we can find support at least 25,620 odd level, that should be okay. Otherwise, it will head to first to 25,400 and then to 25,129 level. This level breaks. Uh, Broader markets also corrected. So if you see Nifty next 50 also was down 2.73%. Nifty Bank, though corrected less, was down only 1.5%. But on daily charts, it has broken the 20 EMA. So it is now looking bearish and RSI is also trending lower. So first support should be around 58,700 and then at 58,000. PSU banks dipped a bit, made a fresh high, it dipped, but this is at least one segment which is in momentum. Nifty IT also corrected a bit, but now the next action will depends on the management committee and the earnings which will come this week. Nifty metals also corrected. Let's see what happens from here. Uh, because the dollar is strengthening, so actually the Nifty metals move in opposite direction. So let's see. Autos corrected, profit booking here, and they also depends on what happens from here because the GST rate cut effect would be over. Defense was the only segment which was positive, was up 1.35% on the geopolitical uncertainty, etc. Midcaps corrected 2.2%, but still it's above the breakout level. So this level of 13,500 is critical. Small cap index corrected around 3%, so all the gains of 3 weeks were taken out. The major dip came in HDFC Bank, dipped 6%, has gone below the crucial supports on the weekly charts, even 50 EMA. So now I think the next level support should be this level of 930, this gap which is here. And if that goes, then it will go and test the 900 level. Reliance also corrected around 7% last week. It has gone through 50 EMA. So I think the next support should be around this 1430 odd level. And after that we will see, but and then it will go to this 1360 level. So we'll have to see how the geopolitics plays out. One major segment which corrected was electrical equipment, and in that Hitachi Energy It has come down from the 22,500 level down straight to 17,800 level, or where 200 EMA is testing that. Went below that, recovered intraday, but looks very weak now. RSI is also weak, it's trending downwards. So I think the first level of support should be around the 16,800 odd level, where last time it had gone up. So we'll have to see here. Now I'll cover two stocks. First is Tata Motors CV. CV industry is emerging from a multi-year down cycle fueled by GST 2.0 due to and push in government infrastructure spending. Heavy commercial vehicles grew 23%, benefiting from rebound in mining and construction activity followed an extended monsoon. Intermediate and light vehicles saw highest jump at 26%, supported by e-commerce and auto logistics sectors. Exports a standout recovery with 70% year-on-year growth as international markets, particularly in Africa and Southeast Asia, stabilize. It dominates the e-bus market in India and is ramping up hydrogen fuel cell and LNG powered truck pilots. Demerger has allowed the CV business to focus its cash flows entirely on its own R&D and debt reduction. Iveco acquisition is a game changer. Iveco Group is an Italian company. It brings in European technology in electric vehicles to Tata's. It allows Tatas to sell world-class high-tonnage trucks in Europe and Asia, reducing its reliance on Indian monsoon and budget cycles because otherwise the CV industry remains a cyclical sector. It still holds a massive 60% share in trucks above 31 tons. However, it has been trading at a 6% valuation discount to Ashok Leyland recently because it lost some ground in the light commercial vehicle segment during 24-25 cycle. Now, coming to, if you see their performance, the volumes were up 21%. Net operating this quarter, net operating income is expected to go up 11%, but is expected to decline fourth quarter. EBITDA margins have improved. So let's see what goes on from here. And profit after tax is also improved by 30%. If you see yearly performance, the volumes are up nearly 10% year on year. And if you see, EBITDA margins have improved, but average realization per vehicle has not gone up. It has come down actually. So that should be a worry. Tata Motors CV, if you see here, if you compare it with Ashok Leyland and Volvo Eicher, this is a market leader, 33% market share, Ashok Leyland 19 and Volvo Eicher 9%. Sales growth 21% year on year for this quarter, Q3. Ashok Leyland 24 and Volvo 23. EBITDA margins are generally the same. Volvo is slightly lower. Key strength domination in heavy commercial vehicles and global technology. High operation and for Ashok Leyland, high operational efficiency and bus leadership. Volvo Eicher fuel efficiency and light and medium trucks. Major technological focus is hydrogen fuel cells and LNG. For them, Ashok Leyland is battery ecosystem. They are going into for the electric buses and electric vehicles. They are getting into battery, lithium-ion cell battery. They've invested 5,000 crore, and these guys are modernizing long-haul logistics. So valuation-wise, they are cheaper. Tata Motors at around 21 times, 21 to 24 times. Ashok Leyland is at 30 times. And Volvo Eicher at the group level include Eicher Royal Enfield, so it is at around 39 times. Seeing the chart after the demerger, it has constantly gone up. So every dip one should look at and see the earnings. So somewhere closer to 400 should be a decent buying opportunity. Next stock I'll cover is Gokul Agro Resources. It has positioned itself as a high growth challenger in the Indian edible oil and agro commodity space. They produce a variety of refined oils under several well known brands. Key brands are Vita Life, Mehak, Zyka, Pride, Richfield, Puff Pride, and Bisco Pride. Product range soybean oil, cottonseed oil, sunflower oil, mustard oil, groundnut oil, rice bran oil, and palmolene oil. Vanaspati, they are a major player in the hydrogenated vegetable oil Vanaspati market, which is widely used by bakeries and sweet manufacturers. The growth is largely driven by increased volumes in the edible oil segment and a strategic shift towards oleochemicals and castor oil derivatives, which offer higher margin than traditional refined oils. India's largest processors of castor oil. This is high margin business compared to regular cooking oil. Products are cold pressed castor oil, pharma grade refined castor oil, and specialized derivative. Applications: these products are exported globally or for use in pharmaceuticals, cosmetics, lubricants, paints, and plastics. Their high grade castor oil and distilled derivatives are seeing strong demand from Japan and Europe for use in cosmetics and lubricants. While they sell directly to consumers through retail, they are also a preferred supplier for large B2B clients who use their oils and fats as raw materials. FMCG giants, Parle, ITC, Britannia, and Godrej Industries are their customers. Company's business model is built on logistical efficiency. Most of their plants are port-based, allowing them to import crude oil and export finished products with minimal transport costs. Gandhidham, Gujarat, close to Kandla and Mundra ports. Haldia, West Bengal, serves the east and northeast markets. Krishnapatnam, Andhra Pradesh, covers the South Indian market. If you're using a branded biscuit, luxury soap, or cooking oil in North Indian household, there is a high chance Gokul Agro was involved in the supply chain. So if you see their uh, quarterly results, they did around 6,600 crore of revenue in September. Growth was above 30% year on year. Operating margins slightly improved around 3%. Profit before tax was up around 40% and net profit was up around 30%. So they are expected to do an EPS of around 9.97 or the trailing 12 months EPS is 9.97. That's around 10 rupees. So this is at around 16, 17 times right now. They have 4,900 crore market cap, so the small cap, so highly volatile. While AWL Agri is 29,000 crore and Patanjali Food is 60,000 crore, but they have other products also other than edible oils. Revenue growth was 37.9% last Q2. AWL was steady and Patanjali was 24%. ROE is much higher than the balance, 27%. AWL Agri 13.9 and 12.1 for Patanjali. Now coming to their chart, so if you see here, it's very volatile. After the Q2 results, the stock went up from that 160 odd levels. It went up and made a high to 220 and then it has corrected and come down to 166 level. So technically it is looking weak and it has come to the support. So any dip closer to 160 should be a decent buying opportunity. Is slightly oversold also. So look to buy this stock. I have finished. We will take questions now.